Welcome to Talk Tickers. Today we are digging into Plug Power's pivotal Q3 2025 earnings call. And let me tell you, this one was a real mix of signals. So let's get right into it and break it all down.
So let's dive right in. This was a quarter of, well, really conflicting signals. You had an earnings beat, a revenue miss, and then a huge strategic pivot announced. This was a really pivotal quarter, and we're going to break down exactly what happened. All right, let's start with the headline number. The good news was a beat on the bottom line. The adjusted EPS came in at a loss of 12 cents. Now I know, that doesn't sound amazing, but it was actually a penny better than consensus, and it sparked a nice little rally in after-hours trading.
However, that positive feeling didn't last very long, because then you look at the top-line revenue, $177 million, and that was a miss of about 5.5% against what everyone was expecting. Right away, that raises some big questions about demand and whether they can really convert on their pipeline.
Okay, so here's where you see the real tension in the quarter. On the one hand, they are getting their house in order. Cash burn is way down. We're talking 53% lower than last quarter. That's fantastic. But on the other hand, you've got this revenue weakness and these huge GAAP gross losses, not to mention almost $250 million in charges for their restructuring, which they're calling Project Quantum Leap. So yeah, operational discipline is improving, but it's happening against a pretty tough backdrop.
So what did management do in response? Well, they announced a major strategic pivot. And you can see here from the CEO, Andy Marsh, she's framing this as a way to kill two birds with one stone. Shore up the balance sheet and, really importantly, get a piece of that massive AI build-out action.
And this slide really illustrates the new playbook perfectly. First, they're suspending the capital-intensive DOE loan activities, basically hitting pause. Second, they're monetizing some electricity rights for over $275 million. And what's key here is that this is non-dilutive cash. They're not issuing more stock. And finally, they're refocusing their efforts on what they see as higher return markets, specifically data centers and hydrogen supply. It's a whole new game plan.
Now, what's really interesting when you dig into the numbers is this. Despite the overall revenue miss, there are pockets of real strength. Take a look at their GenEco electrolyzer business. It jumped 46% sequentially. That's huge. It shows you that the core hardware business is actually pretty resilient, which is a really important data point to keep in mind.
All right, so let's look forward. What are the key milestones that investors are going to be watching over the next year to see if this new strategy is actually working? Well, here they are. In Q4, we're looking for that gross margin checkpoint. Then, in Q1 of next year, we need to see that big monetization deal close. In the first half, there's a leadership transition. And by the second half, we need to see if they're on that path to being EBITDA positive. This is the company's report card for the next 12 months.
So, all of this, it really brings us to the key question for the stock, right? Is this pivot a real inflection point? Is this the moment the company truly turns around for good? Or is it just a temporary fix, just buying them a little more time before the old problems come back? That's what everyone is trying to figure out.
So, our view here at Talk Tickers is market perform. And here's why. The operational gains and that big cash injection are definitely promising. They've absolutely bought themselves a crucial lifeline. But, and it's a big but, there is significant execution risk on this new data center strategy. That's what keeps us on the sidelines for now. The burden of proof is squarely on them to execute this pivot.
Now for our final segment, let's explore a potential trade idea that's centered on a bigger macro theme, something we're calling the AI power squeeze. The thesis is pretty simple. The exponential growth in AI data centers is going to create a massive energy deficit. It's going to strain our grids and force these operators to look for alternative power sources, things like hydrogen fuel cells for backup and for grid stability.
So here's a trade idea, and look, we're calling this the wild but plausible trade for a reason. The thesis is that the market is seriously underestimating just how quickly data centers will have to adopt hydrogen for backup power. So the play? You could look at long-dated call options to try and capture the upside from a potential landmark data center partnership announcement sometime next year. Now, the risk is obviously huge. If this pivot fails to get commercial traction and their cash burn starts to accelerate again, well, you could lose everything on that trade.
And that concludes our analysis. As a reminder, this is not financial advice.